Indian markets entered May 2026 riding a high. After a strong rebound in April, many investors believed the rally would continue. Domestic growth remained resilient, SIP inflows were steady, and corporate earnings were expected to hold up. Some even brushed aside the old Wall Street adage, sell in May and go away, believing that India's structural story was too strong to follow that route. The phrase refers to a long-held belief that stock markets tend to underperform during the summer months, May and October, prompting investors to reduce exposure during that period. But as the month progressed, they had their answer. The BSE Sensex fell 2.8% in May, while the NSE Nifty slipped 1.9%. So what went wrong? Through May, a series of pressures compounded. Brent crude climbed above $100 per barrel and stayed there for most of the month, driven by escalating US-Iran military tensions in West Asia. That single factor triggered a chain reaction: fears of inflation, a widening current account deficit, and rising fuel costs. The government responded with successive retail fuel price hikes, adding pressure on consumption and corporate margins. That cascading impact was severe. Foreign institutional investors, or FIIs, sold Indian equities worth 55,963 crore rupees in May. A key reason was the rise in US bond yields. The US 10-year Treasury yield climbed to 4.6% during the month, its highest level in a year. As returns on US assets became more attractive, money flowed out of emerging markets including India. The rupee bore the brunt. It fell to a record low of 96.96 against the US dollar. A weaker rupee increases the costs of imports and raises concerns about inflation and capital flows. Together, rising oil prices, FII selling, and currency weakness created a difficult environment for markets. Back home, the March quarter of Q4 FY26 earnings season wrapped up broadly in line with estimates. But that was the problem. There were no major disappointments, but there were also very few positive surprises. Without strong earnings upgrades, markets lacked a fresh catalyst to move higher. So what drives markets from here? Analysts say several factors will now determine the market's direction. Crude oil prices remain at the top of the list. Investors will also closely track foreign fund flows, the rupee's movement, the RBI's policy commentary, monsoon progress, and trends in rural consumption. Many experts expect markets to remain range-bound in the near term. Instead of a broad rally, stock-specific opportunities may take center stage. Despite the recent volatility, not everyone is pessimistic. Morgan Stanley remains positive on Indian equities over the long term. The brokerage says foreign investor positioning is near multi-year lows. Valuations have corrected, and India's manufacturing ambitions could drive growth over the next decade. It also sees opportunities from expanding energy infrastructure and the country's growing role in the AI and data center ecosystem. Morgan Stanley's base case target for the Sensex stands at 89,000 by June 2027. So May was a reminder that even strong domestic fundamentals cannot completely shield markets from global shocks. For now, investors are balancing two competing realities. On the one hand are geopolitical tensions, high oil prices, and foreign investor exits. On the other hand is India's long-term growth story. The coming months will reveal which narrative proves stronger. Follow Business Standard for more stories.